So we got to talk about these LA fires. Obviously, really, really sad, really, really tragic. But from a Lemonade investor perspective, what does this mean for us? I mean, we've seen the photos. There's massive devastation, entire areas, neighborhoods wiped out by these fires. And for Lemonade, California is still their largest state in terms of gross written premium. About 23% of all their premium comes from California. Now, this is for all their product lines, not just homeowners, not just car, all of their product lines, but still the biggest state of all. So does this mean, is this a doomsday scenario for Lemonade? Or is this really a nothing burger and it's all just overblown and really means nothing for Lemonade? Because, hey, on the one hand, this is from 2022, Lemonade stopped writing home business in California all the way back in 2022. And we know they've even non-renewed a lot of their homeowners' business. So is this a massive, are we screwed existential threat for Lemonade?
I declare bankruptcy!
Or is this a nothing burger? We're going to try and answer that in this video. And to be absolutely clear, nothing on this channel is personal financial advice. And to be absolutely clear, I don't think anyone outside of Lemonade itself, that company, the employees there, nobody else knows with 100% certainty the answer to this question, but we can at least increase the certainty, and I think that's what we're going to do here in this video, because my guess is this is mostly a nothing burger, and I'm going to give you my evidence of why I believe that's the case. So I wrote this on X earlier, and these are the key questions that kind of help reveal how much are we really at risk for, on the hook for, as Lemonade investors, as Lemonade owners from these LA fires. So my questions really that I dug into are how much, California home does Lemonade still have? Would their risk models have identified the Palisades and other hit neighborhoods of LA as areas to non-renew or avoid? Were these obviously risky areas that Lemonade would have backed out of and non-renewed out of? Or not? And are there any parts of the Palisades or other hit areas that would be likely customers for Lemonade? So, and then I shared one anecdotal story. It was from somebody in the Orange County thread. It said, "We do live near the hills." This was a year ago. "I'm sure the actuaries consider my home at increased wildfire risk," and saying that Lemonade dropped their homeowners policy. So that was a great sign. Sorry there, false spin 3554, that your home insurance was canceled, but it's great for Lemonade. It was great for Lemonade. And of course, we all know, if you're following the Lemonade story at all, as not only are they non-renewing home, they're selling a lot less home over time if they really sort of backed out of that product. One question I asked Grok, just to get a sense of, hey, the Palisades and these other areas that were hit, how likely might these even be Lemonade customers? I asked it for a spectrum of home prices in the Palisades area of LA. It said the lowest end of those houses might be $950,000 range. Highest end, you might be as high as $40 million, maybe even higher. So massive sort of luxury celebrity homes. A lot of those were taken out. But even at the low end, it's not like these are just fixer-upper houses. They're still like close to $1 million houses at the lower end. So I think this is some advantage for Lemonade, because more of their customer base is going to be probably the simpler, cheaper homes, I would think. And then Domian had this really great post. He said the entire LA area was dark red in this home map from investor day one. And if you zoom in on the map here, you can see that the scale on the map from green to red was the estimated lifetime value of customers coming out of each of these positions for the home product. Of course, the LTV models are going to get better and better with time. This was LTV 6 for Q2 2022. At the time they shared at Investor Day. But you can see in California, there's tons of red, and especially in the LA area, right around there where these fires were, it's all red. So that's, I quoted Domian's tweet and basically said, this is great news because it shows, hey, 2 years ago, Lemonade knew that this LA region was a major problem and was underpriced for the amount of risk that they're going to have, and that massive fire like this could sweep through and cause massive damage. So much of their non-renewals, I'm going to guess, might have come in part from the LA area. We're going to look at that a little deeper in a second. But it's really reassuring that over 2 years ago, they already knew this was a problem. So likely they could have backed out of a lot of these LA area homeowner policies, just like the Orange County Reddit post we saw. So then I took, and shout out to a number of people in the Lemonade investor community online. So shout out to Matt, Domian, Josh, Brian, so many great people. I was bouncing ideas off and heard so many great ideas. So one thing Matt told me, Matt Moores, is he was playing around with using ChatGPT to count these dots. So that's what I did. I put this picture into ChatGPT. I asked it to count the number of green dots versus, positive dots versus negative LTV dots. And this is what it found. It basically said there's a total of the negative LTV dots, there's 635 out of the 2,500 total dots. So about 24, almost 25% of the dots are in the negative LTV range. About 25% of the homeowners policies back in Q2, Q3 2022, we could assume they wanted to cancel or at least increase the price on. Now, I've estimated back then, and some of this comes from Domian's estimates too, so shout out again to him. But the home portion of the book of business back around Investor Day 1 might have been like 150 million of IFP, 140, 150 million range. Right now, it's probably, again, estimating it might be around a similar range, 150 million. So obviously there's been probably a lot of change in that book of business where they've written home policies in places with the green dots on the map and canceled most of the red dots. But you can see that back then it might have been around 140, 150 million dollars. And there's evidence, over the last few years since then, that they've been canceling those policies out at a significant rate. So this was from Q2 2023. They said already around 2,000 home policies have been non-renewed. And while actions like this slowed down are, metrics like annual dollar retention, premium per customer, they benefit our long-term profitability. This will be an ongoing process with a lagging impact. Flipping back to here, if we think, hey, it's an average of, just assuming maybe it's $1,500 per customer as an average premium per customer for home over the last few years, and then say even, in that quarter was 2,000 customers, 2,000 times by 1,500, you're talking about $3 million of IFP that came off the books. Again, this is back in Q2 of 2023, so a while back ago. But they would have continued to cut more policies over the next several quarters. Even this was from Q3's earnings call, and they said, we noted last quarter, this Q3 of last year, so just a few months ago, we noted last quarter that we expected to remove 25 million of home IFP from our book in the second half of 2024. So luckily, probably continue to cancel policies all the way up, to the end of last year, before this fire really started. And they said 2/3 of that were done earlier in Q3. So I'm sure there's 25 million that came off the book. So, flipping back to this map and ChatGPT's estimate that maybe this is 25% of the dots. Now, of course, these dots, I don't know how proportional they are, how they plot them in here, how accurate exactly ChatGPT's account was, but 2,500, seems like a reasonable guess, and about 25% of the dots being in the negative seems like a reasonable guess. And from our model, if we think about it, that maybe they had 140, 150 million of IFP back then when this was shown. So if we take 150 million and take 25% of that as being the bad dots, maybe you're talking that there's like 38 million of bad negative LTV homeowners at that time on the book. And, you're going to continue to sort of churn out some of these, cancel some of these. And to me, something in that range, maybe it was 140 at the time of this slide. So 35 million, somewhere sort of in that mid 30s range. They canceled 25 million over Q3, Q4. And we know that in other previous quarters in, 2023, they were canceling homeowners as well. So my guess is most of these red dots on this map got canned. which is great news because basically all of LA's can. So just like that Reddit post showed that I showed you earlier, probably nearly every homeowner's policy in this area got canned, and you probably saw people leaving bad Trustpilot reviews saying, oh, my roof's perfect, everything's beautiful in my home, and they just canceled my policy. Well, Lemonade was right because they probably saw that, hey, we're not charging nearly enough for the amount of sort of wild, massive devastation catastrophe that could occur, such as a massive wildfire that rages through Los Angeles. And so my guess is most of these dots on the map are gone, just based on sort of the rough math of, hey, 25% of this map is showing bad dots, and that roughly checks out with the math of sort of probably how much homeowners they've non-renewed over the last few years. Now, moving on, if we think about what is the definition of property and casualty in Lemonade's perspective and their product lines, property and casualty, my understanding is to include the home, car, and renters. Someone's talking about that type of insurance business. Wouldn't include the pet insurance and the life insurance, but in all of these three cases, you could have catastrophic losses. Home insurance, of course, would be the biggest. Car insurance, though, you could, and renter's insurance. In the California Department of Insurance, it shows, this was from 2022 report, published 2023. They show that Lemonade had 0.19%, so just under 0.2% of market share for property and casualty insurance written in the state. So 0.2% was about 179 million. And then in the next year for 2023, they had, again, 0.19%, a little bit higher, 191 million. Now, of course, Lemonade might have been canning a whole bunch of their home policies, but they might have been adding a whole pile of maybe car policies, maybe renters policies, especially, I would guess. But anyways, it's held pretty steady. Lemonade's held about 0.2% of the market share. Now, to try and actually quantify how much this might actually cost Lemonade, the latest estimates for the total damages I've seen at 150 billion, though that could go higher because I think the fires are still occurring. So maybe it's 150 billion, maybe it's 200 billion. It's probably 100 to 200 billion, maybe in somewhere in that range, but 150 billion is kind of the latest, with insurance losses crossing 20 billion. So insurance losses crossing 20 billion, while total damages costing 150 billion. You might be wondering, what's the difference? Why is that discrepancy so large? I asked Grok. It says the 150 billion and the 20 billion insurable damages would include things like that difference is made up because there's some properties destroyed that don't have insurance. There's insurance. There's things like environmental cleanup and long-term environmental economic impacts that occur in the whole region. That is huge part of those damages. Maybe they didn't have insurance to the full extent of the loss. And then another huge one would be public infrastructure damage. So it might not be insured or partly sort of covered by government funds, where you're rebuilding entire roads, roadways, massive forms of infrastructure like that. So that's why you can have, I guess, this huge difference in the sort of total damages versus insurable damages. And then one other piece of information before we pull up the calculation here I'm going to show you is that the latest information is, and I've seen this a few places, is that there's about 12,000 structures that have been destroyed or damaged in the fires, including homes. And so about 12,000 total houses or buildings that have been destroyed or damaged. And shout out again to Brian, member of the Lemonade community, because going through some messages with him and Matt sort of help think through a way to estimate, quantify what this might be. So the way I'm thinking about the total loss from fires, from these LA fires for Lemonade, is that if you think about the total insurance losses, let's just say that's $20 billion. And then let's just say of all the property and casualty insurance in California, Lemonade, as a report shows, they're at about 0.2% of all of that. So they're about 0.2% of all of that. So if it was perfectly spread across all houses, across across all of California, you could easily then sort of, maybe based on the $20 billion total loss, calculate what percentage of that is Lemonade's. But if you think about it, there's probably a chance, if you're going back to this map, that over the last 2 years, they've really downsized their Los Angeles book of the property and casualty business. And of course, they might still have renter's insurance there, but they're probably not insuring these $1 million homes, $10 million homes in the Palisades or other areas around LA that were most affected. My guess is they've proportionally shrunk that to be smaller than their proportion of the entire book of business. So let's say even if they have, maybe it's 50% less. So it's 1/2 the sort of density they have in that area versus that they have spread out through the rest of the state. So I'm putting 50% in the affected zone. And then I'm also saying maybe it's about half of the damages are covered by reinsurance. Now we know they have this quota sharing, 55% quota sharing program from reinsurance. Reinsurance is, I know it's quite complicated how it's sort of layered on, and there's maximums that are covered and minimums that are, but if we even just assume that reinsurance over and above kicks in and it covers half of what the total damages could be, just put in the equation there, these multiplied all together with 1 minus whatever's covered by reinsurance, you're getting about $10 million loss from the fires. So for a company like Lemonade, they have something like close to $1 billion in cash and cash equivalents. Really not this in my opinion, it's a total nothing burger. Now, let's just say this grows from 20 billion to 30 billion. We know this number was solid. We're not guessing on that one. Let's say even it's 100%. Let's say it's equal density across the whole province. I live in Canada, the whole state of California. You're talking like a $30 million loss, right? $30 million loss. Again, not existential. That would suck. It's no good. It's not great. You're going to have a high loss ratio for a quarter or a few quarters or whatever the case may be, but it's not an existential threat, right? Even if this was 55%, maybe you're at 27 million. So maybe at the low end, do you think this is 20 billion? And maybe you say, hey, they really, really sliced everything back. They have almost no home there. It's just renters and small renters, policies, and they'll have small payouts on some of those as things are damaged or properties damaged, but much, much smaller than the sort of building homeowners side of things. So maybe this is 15%. And 55% is covered by reinsurance. At the very best, you might be like, yeah, this cost Lemonade $3 million. Big deal, the biggest nothing burger. We're going to get huge discount on the stock just because we all know it's probably going to go lower, very likely going to go lower because the market is just going to lump any of these insurers that have any sort of coverage in the area together. Now, do we know this is for certain? No. Like I said at the start of the video, anything is possible. Lemonade could be entirely screwed. There's not a 0% chance of that, but in my opinion, it's a very unlikely chance because even if this grows to 40 billion, it's like way higher than people thought. This number is solid. Maybe it's 100% of the book is in there. And say reinsurance doesn't cover as much as we thought because there's limitations as things max out. So maybe it's 40%. You're still at like a $50 million loss. It would not be the end of the world for Lemonade. It would suck, but not be the end of the world. That would be one of the more worst case. If this is 30%, you talk $56 million loss, right? So really, really not that bad. That again may pump this even higher. These are extreme numbers. Now you're talking 70 million. So again, it's getting worse, but this is extremely unlikely in my mind. In my mind, the most likely case is maybe this is 25 million. This is here 20.2%. Maybe this is 25%. And maybe this is, 50%. And you're talking like a $6 million loss. But again, it's no big deal in the grand scheme of things for lemonade. Now, again, do we know that this is 25%, this sort of density versus their overall density for all of California? We don't. How do we know with total certainty that they didn't just go crazy and sell home insurance to everybody in all of LA, and versus the rest of California, they're actually way higher, and they're 3 times higher density than the rest of California, so they're 300%, and we're going to pay $75 million. Still not even the end of the world. Even if that was the case, though, that would make no sense given all the communication we've had from management over the last few years. So I hope this helps quantify this a little bit. And then over here on the side, I put, hey, 12,000 structures damaged in the fire. If you take, again, this percentage of 0.2% of those structures, if that holds true, and you say 25% of the sort of density again in the LA area, then you're talking, maybe there's 6 structures that you're renewing. And that roughly makes sense. Maybe then your cost, you get paying $6 million and you're covering these 6 things. Of course, there's a little more complicated than that. I think the dollar version might be a little bit better because there's things like the renter's insurance still in there. You're going to have some claims from that. Car insurance still claims from that. But I hope this gives you some analysis, input, thoughts on how I'm seeing these fires. In my opinion, I believe it's very likely a nothing burger. And so much of life, we don't know the probabilities with absolute certainty, but you can, at best, you can kind of increase the certainty as much as you can and then make decisions in spite of that. If you got value out of this, make sure you hit that like button, subscribe if you haven't already, and feel free to join my Patreon. I have nearly 90 people in the Patreon. I never thought when I started it would grow that big, but shout out to those. I think it's 88 people right now that are in the Patreon. I hope to continue making exclusive content there, and if you want full access to my Lemonade model, it's in there. I'll be continuing to improve that, always have and will be over time. So shout out to those people, and if you want to support the channel, shout out to you. I'll leave the link for that down below or up above in the video. But thank you so much for watching. Remember, it's in the bag.